All right, so today here on the show, we've got Ben Rabidoux with North Cove Advisors. For those of you who aren't familiar and aren't following Ben on Twitter, I highly encourage you to do so. But Ben runs a research firm servicing institutional clients, investors, and specializes in identifying hidden risks in the Canadian credit ecosystem. Ben has a particular focus on housing and credit, so obviously probably no better guest here that's suited for the channel. But Ben, you've also recently launched another service called Edge Analytics, which is catered to the real estate industry professionals, and which I personally subscribe to as well. Why don't you tell us a little bit about this service first and foremost before we really dive into the meat and potatoes here?
Sure. Yeah. Thanks for asking, Steve. And thanks for subscribing. You're one of the first ones, so I appreciate that. So the idea there is through North Cove Advisors, it's research that's exclusively available to institutions. And over the course of the last few years, I've given some presentations for real estate boards, appraisal groups, those types of clientele, and frequently asked whether they can get on the distribution. Of course, the answer is well, no. It's it's institutional only, and it was a tough sell for my institutional clients because, of course, they don't want the research being distributed widely, and of course that makes total sense. So the thinking there was, well, if we can instead structure it where I can provide some of the insights that I'm giving to institutional investors, and get that in the hands of real estate professionals like you, but also create the ability to sort of pick your brain, create a network of frontline contacts where we can gather some intelligence regarding forward-looking indicators like website traffic or open house foot traffic, get some insights into investor participation in the market and just your general perceptions on future pricing trends. And then on the mortgage side, maybe pick people's brains around what's happening with financing conditions, not related to mortgage rates. So what's happening with underwriting broadly. That's very timely and insightful information for my institutional clients. And so there's sort of a way that I could say, look, there's something in this for you if we can roll this out to real estate professionals. And then that survey data would also be available to subscribers of Edge Analytics. So it's a research service that's exclusively available to real estate professionals. 2 reports a month at minimum. So you get a metro level deep dive. So kind of first week of the month, once all the metro level resale data comes out, do a deep dive of some of the major metro and some of the big trends. And then third week of the month, you get the Edge report, which is just kind of a gathering of all the relevant macro indicators that would be important for folks like you or folks in the mortgage space. And then the other thing that we're doing is every month taking some of the key learnings, putting them into neat infographics that then folks like you could turn around and share on social media without attribution to me. It's just sort of pre-made for sharing, just the idea being to make you guys look smart and also to inform and educate your clientele. So that's the value proposition for you guys. The value proposition for my existing North Cove clients is we get to create ideally this sort of broad network of frontline contacts and pick your brains, right? So it's sort of a win-win.
Yeah, no, I mean, I think it's brilliant. Like I said, I mean, obviously anyone that's sort of followed some of my work, you guys know that I'm sort of data driven, and a lot of that is Ben is almost, I want to say, sort of like almost like a mentor in that space. Just, I really look up to a lot of your research, and so again, for anyone, again, there's gonna be people in the retail space that are watching this. I'm like, hey, can I subscribe? Unfortunately, again, Ben has to kind of keep a wraps on things too for his institutional clients. So, but if you're a realtor, mortgage broker, developer, whatever, this is definitely a good product for you. And
yeah, I appreciate that. It's $30 a month. You cancel it anytime if we suck. But you do need a professional email to sign up. It can't be a Gmail. It'll automatically kick you out, and everyone is vetted prior to being approved. So we need to know that you actually do work in the space. So, but no, thanks for that. I appreciate that, Steve.
So yeah, what we'll do is we'll put a link in the description below, but what we can do for the retail people that aren't subscribed to it or don't have the ability to do that, we're going to get a lot of Ben's thoughts, meat and potatoes in this interview here. So let's sort of dive into it. Ben, again, for those of you who haven't been familiar with your work in the past, I've known you for quite a while here, but I know that, you tended to be, you're very balanced. You always call the market what it is, but I think you tended to have sort of maybe a little bit of a pessimistic view or skeptical view, I should say.
Yeah, no, that's fair.
Similar to me, I'm skeptical of the ability to sort of continue to expand credit and continue to push house prices significantly higher. Obviously, that has been the case. But, sort of framing this up, I mean, we talk about all the levels of household debt in Canada, the extremely high house prices. People have been, I'm sure some of your clients too would probably mark this as arguably, overvalued real estate, maybe a housing bubble that never burst in 2008, 2009, kind of kept going again against all odds. And then we got this global pandemic and we're like, oh my gosh, if you ever were looking for a catalyst to set this thing off. So, the pandemic unfolds and you go, holy smokes, these guys are shutting down all the businesses, record unemployment, record job layoffs. Obviously we had initial liquidity concerns, the financial system drying up essentially. But the housing bust failed to materialize. I mean, we had CMHC, who I like Evan Siddall. I think he's a good dude. Came out with this forecast, and these guys have more data than anybody. And you're like, well, again, if there's ever was a catalyst, you would think it would be record unemployment, but again, you just penned a report in your service here called The Depression That Wasn't. Can you walk us through that? Like, what the hell happened? Like, obviously, I'm fairly familiar with it, but for people that are listening here, walk us through it.
Sure. Let me actually back up if I could and just kind of frame how my thinking was changing prior to that, because you're absolutely right. I've been skeptical on things like household debt levels in Canada, the sustainability of house prices, outstripping income growth, for example, in perpetuity. But I would say that, if we really have to be careful of thesis creep, for lack of a better word, right? And when we look at housing in Canada, my view, amongst other things, was that I always recognized that there was a supply shortage in the single family segment. I was sort of the view that a lot of that supply shortage was also a function of excess demand, speculation, and perhaps foreign capital flows. And so if you go back to 2017, we had this big run up in prices, 2016, 2017. The Feds came in and they hammered the market with B20 stress test, insured mortgage stress test, and then regionally you saw these various measures to kind of combat foreign investment. And I think it absolutely worked. I mean, my read on foreign capital flows is they fell quite significantly in Canada. So you sort of take that off the table. You had credit growth slow dramatically, which I would have argued, if that happened, you'd see it reflected through house prices, right? And we saw it for a few months in kind of the single family segment in Vancouver and in parts of kind of the 905 in Toronto. But then it very quickly stabilized and then it just kind of started going back up again. And so I was watching this, and by 2019, what struck me is we started to see just this persistent monthly decline in active listings across the country. Every month, stable, seasonally adjusted declines. And then so you're watching this, and at that point I had to say to my clients, look, this is getting pretty dramatic. There's a real shortage in active listings. And by the end of 2019, the market in Canada was far tighter than it was in 2016 and 2017 when they brought in the stress test. Inventory was much lower, months of inventory were lower, and so I was saying, look, something needs to change or we're going to see an explosive move to the upside in prices. And I think that's where we were in Q1 of 2020. We were set to see an incredible spring market, and then COVID came along. And so my thinking around housing, I just hate the idea of just having this constantly evolving bearish thesis. Like, well, it wasn't happening, right? We're obviously missing something. And so you have to just recognize what was happening in the market, and inventory was disappearing. And you can't have a housing downturn or even just a soft landing if you had this market continually tightening, right? And so I just kind of came to that conclusion. Look, this is not set up for a downturn. It's set up for the exact opposite, and this thing's going to explode to the upside. Along comes COVID, and then to your point, the early days of COVID, everyone was just, all bets are off. And it was very difficult in the early days of COVID to sort of envision an outcome that wasn't very negative for housing. And some of these people that are kind of, spiking the ball and trying to dunk on CMHC, it's like, guys, do you remember how close to the brink we were in Q1? Like, that was friggin' terrifying, right? And you had every economic indicator just fallen through the floor. Record, as you said, record jump in unemployment. Everything looked awful. So I think that was a very rational conclusion to come to, is that this had to be a negative outcome for housing. Now, it ended up being very much the opposite. And so what I focused on in that report, just looking at what happened to employment growth. Like, yes, we had this huge decline in employment, but if you segment it by income, you find that actually the top 40% of income earners, which earn $30 an hour, the equivalent of and above, employment only dipped about 4% peak to trough, compared to almost 10% for the overall Canadian economy, or the labor market. And then by June of 2020, it recovered, and it ended the year up 10%. And so employment in the top 40% of the income bracket had actually expanded by the end of 2020 and was above where it was at the beginning of the year, which is crazy. And so it sort of makes sense looking back. You recognize that, yeah, most of the job losses were in sectors like retail and hospitality and relatively low paying jobs. And the dirty secret of this pandemic is that if you're in the top half of the income distribution, it's actually been the best of times for you. And it's terrible to say that. And I don't mean to in any way diminish the very painful reality for a lot of households across the country, but you had a situation where incomes in general expanded through the recession, which we've never seen before. Household savings exploded to the upside. I mean, some of the charts showing, if you just look at checkable deposits, personal checkable deposits at chartered banks, it's an insane chart. It's just this long, steady rise, and then all of a sudden it's just a hockey stick. And you're, at this point, by my estimates, you're $115 billion above pre-COVID trends, right? So you've got a situation.
Is that just a situation where people are just throwing money in the bank?
Yeah, that's what it is. So you've got all of this excess savings. The savings rate spiked, which you don't see during recessions, right? It hit almost 30%. It's still, in Q1, it was 13%. Household disposable income spiked, hit I think about 16% year over year. It was still up about I think 9% year over year in Q1. These are big moves. This doesn't happen in a recession, right? And then you had the situation where people had nowhere to spend their money. And so you end up with savings rising. And the other thing that happened is you had consumers aggressively pay off credit card debt. So non-mortgage consumer debt actually fell throughout the pandemic, which you would not expect going in. And so the strange thing was, by the end of the pandemic, households on balance were in better shape than they were going in. And again, you feel terrible saying that, because I don't mean to diminish, this is a very difficult time for a lot of people, but on balance, Canadian households delevered their highest interest credit card debt, and they piled up a stack of cash just sitting there that we've never seen before. And so, it sort of makes sense when you frame it from that perspective that, yeah, housing actually did fairly well. The other thing that happened, to get back to the resale market, is there has been a persistent undersupply of single-family housing. And we can see this through various metrics, but one of the things that I put in the most recent note was we just looked at single-family housing completions by decade. And I don't want to botch my numbers here, but I through the 70s, 80s, 90s, 2000s, you were averaging, I'm going to say 1.3 million completions, and population growth was averaging about 3.1 million each decade. Okay, so I think that gives you a ratio of about one new single-family home for every 2.4 people out of the population. All of a sudden, you hit the 2010s, and now you've got single-family construction declines to closer to 1.1 million, and the population explodes to almost 4 million during that decade. And so that ratio blows out to almost 4. And so if you had held that ratio constant through the 2010s, you would need almost another 600,000 single-family homes, which is an insane stat, right? And so, look, I would say I underappreciated potentially the magnitude of single-family underbuilding in Canada, and we entered the pandemic with very low supply, and then all of a sudden you hit a scenario where consumer preferences change, and now suddenly people want lower density, single-family suburban living, which was the exact thing that we weren't building enough of, right? And so it was just this confluence of factors that you end up with an absolute boom in housing during the worst recession on record. Right. Yeah,
I mean, I can just say, put my realtor hat on here, but I live in this right in the city of Vancouver, and I was kind of saying this for a while. I'm like, I'm really bullish, like East Vancouver, and because what happens, I think people need to understand, like in Canada, at least I should say, at least in Vancouver, we don't build nobody's building single family homes. Like, we don't, it's not like we're going out and building new subdivisions. There's nowhere to build. And so, for example, in the city of Vancouver, every single year, the number of new single family houses is shrinking. Like, we see more and more density. So, like, all the houses along the arterials are being packaged up to developers and built into condos. So, like, literally, like, again, this is the core city of Vancouver. Like, we are every year shrinking single family homes. I don't know if that shows up in your data necessarily, but I mean, I can't think of.
When you say shrinking, you're talking about the stock of single family homes declining because of. Yeah, I think that's right. I think that's probably right. You get that information in the census data. So I suspect when we get the census data, you'll see, probably there was a decline in the housing stock of single family.
I got to ask you, I don't know if you were, one of the things that I was surprised at during the pandemic was, so when it was kind of happening, and like, I understand, like, you've got the data, so households are saving money and there's less money to spend on. I was just surprised by the psychological aspect that, at the height of people losing their jobs and looking around and go, oh man, this is kind of scary. I was just surprised that there were so many people that were willing to take on more debt in the form of a larger house. Because, like, I mean, for me, maybe I'm just a little bit of a paranoid guy, but I was like, oh man, like, this is not a time I'd want to be buying a house. Like, like, I don't know, is my income gonna get slashed in half here? I just felt like it was time to sort of batten down the hatches. But don't get me wrong, I remember looking around in like June, and I was like, early June, and I was like, oh, these crazy people getting into multiple offers on single family houses. This is nuts. Mm-hmm. And it just kept going.
Yeah. Yeah, I'm with you. I mean, I think the early days are kind of going, geez, that's a lot of risk to be taken on. But I think we underestimated just how much consumer preferences changed and how quickly they changed. I think everybody all of a sudden recognized this work from home thing might be here for a while, and all of a sudden you're longing for a bit more green space for your kids to run around in. There was some pent up demand. We do know that millennials and to some extent Gen Xers are still underhoused in the sense that their ownership rates are arguably lower than they should be. So I think people probably in the early days thought they were going to get a bargain, right? And you went from people looking for value in the early days to all of a sudden going, geez, I better buy or I'm going to be priced out. Like, it flipped so quickly. It's like the value hunters became the FOMO buyers in just like 6 weeks in mid 2020 there, right? Like, wasn't that how it felt for you?
Oh, totally. Yeah. I mean, I think, like, now I'm looking at the market here, and I've come out and said this fairly publicly, is like, I think everything I see, not just in the data, but from a sentiment perspective, I think we peaked out in March. Like, we're transitioning. I don't know what's going to happen now. I mean, I'm kind of curious your thoughts. I mean, you're obviously in Greater Toronto area there. Yeah. But I mean, suburban houses, right? I mean, up what? How much are they up there? 30, 35%?
Yeah, it'd be around that. Yeah, single family suburban is, and when the funny thing is, you get into the smaller metros, and it's like 40%. I mean, all these crazy little cottage country areas have just exploded, right? But you're right. If you look at what's happened since the March peak in Vancouver, by my math, you've got seasonally adjusted sales are down over 30%, right? Now that's off of record levels. Like, everything here is weird because you're comparing it to these peaks in March that were just so absurd, right? In Toronto, sales are off about 20% on seasonally adjusted terms the last couple months. And actually, it was interesting. They had some big downward revisions to some of the earlier data, right? So some of their January, February data was revised down quite a bit. But whatever, you went from an absolutely insane level of sales down to something that's a little more, I don't know, just a touch cooler, right? But the important thing is sales aren't just in a vacuum. You need to look at sales in the context of supply, right? And I'm telling you, months of inventory, which is my preferred measure to watch, right? So months of inventory for the people who are listening is just the housing supply divided by the most recent month of sales, right? So if you have 100 homes for sale, you had 20 sales in the previous month, you'd say there's 5 months of supply. It would take 5 months to clear that supply. So normally in places like Vancouver over the last decade, you kind of averaged around 5 months of inventory, and you're like 2.7 or something, somewhere in that ballpark, like roughly half. And it's about the same in Toronto. And it really doesn't matter which segment you're looking at, single family, condo, you're around a half of what the normal months of inventory is. And so you got a long ways to go to bring this back to balance. So I think we need some perspective. It feels like it's a dramatic slowing because, when you're going 200 miles an hour and all of a sudden you slow down to 120, it feels like a dramatic deceleration, but you're still going 120, right? So, and that's kind of where we're at in this market. And it's just hard to see. Like, I'm happy to talk about where I think the risks are, because I do think there's going to be an inflation scare in the back half of the year, and I do think we're going to see yields start to move higher, and that's going to pressure your fixed mortgage rates. So, I mean, I do. It's look.
Yeah, no.
I'm not at all convinced. I just want to be clear here before we move on. I don't at all believe that we've eliminated permanently the concept of cycles. Okay, and so I don't want people to misunderstand what I'm saying.
You don't believe in the Fed put?
Listen, it's been hard to argue against it, right? I mean, the Feds came in, and it's almost a situation where you go, if B20 and if the foreign buyers tax and if now COVID and everything we've seen hasn't dented housing, like, what is it going to take, right? And I think that's a fair question. I think one of the things that the Feds have signaled is that there is a put to housing, right? They will go out of their way to support housing. Right, and so yeah, look, you need. I
want to get into this very deep, because this has been the biggest thing for me, right? So again, everybody that's watching this channel, we've got a lot of loyal subscribers here, and I was more bearish. I've been skeptical, and I somewhat like you, I suppose, flipped quite bullish, and I've been fairly active in the real estate market personally for myself. I
saw you get some flack for that on Twitter.
Yeah, getting flack for it, and I've been saying on the YouTube channel here was that we were kind of set up for a significant correction. I think you should have had it in March, April, whatever. But it was evident by the policymakers' decisions, the Bank of Canada coming in with massive amounts of QE, basically buying up anything, mortgage deferrals. Like, if you had asked anyone a couple of years ago, hey, do you think at some point banks would just tell people they don't have to pay their mortgages for 6 months? Like, that's insane. Like, nobody thought that would happen. But again, in a crisis, like, things happen. And so my whole view is like, listen, these guys had a chance to correct housing. It's clear there is a put there, and you can agree with it or disagree with the system and the decisions that they're making, but this is the reality that they are going down.
Listen. How dare you change your mind in the face of changing statistics? That's not how this is supposed to work, Steve. You're supposed to be a zealot. Okay, that's what everyone on this channel wants. Somebody who's just going to double down even when the data changes.
Well, I mean, if the M2 money supply is going to expand by 18-19%, and these guys are going to run $5 billion of QE per week, I just don't see how your thesis can change. But I mean, now let's talk about the risk, because we're not out of the woods here. We've had a huge run up in prices. Debt levels are even higher. House prices are obviously higher, and probably you could certainly argue more unsustainable, because it's not like we've really had a whole lot of wage growth. Population growth
that's the weird thing. Well, not wage growth, but household disposable income growth.
Yeah, right. And I think, with the inflation thesis, wage growth is probably coming.
I agree with that.
But so the population growth, we can get into that, because I think, we haven't really had any, that was the whole thesis in 2016, 17, right? And so many people, everybody wants to live here. We're not building enough. But I'd love to get into that. Like, where are the risks?
Well, okay, let's start by saying this. If you've been a housing observer for a number of years, and if you've been concerned about housing as you and I have been, and you've watched the Feds bring on a series of macroprudential measures to tighten credit, to target foreign investment, which I do think has worked. It hasn't driven it out completely, but they've signaled a willingness to curb that. And then you watched COVID come, and you've seen dramatic government responses to underpin housing. If you've seen all that and your view hasn't changed somewhat, you're missing the boat here.
Well, it's emotions over actually trying to, make money or position your life better or whatever.
Yeah, that's right. And I'm not, like I said, I'm not convinced that we've forever gotten rid of the concept of a housing cycle. But you do have to recognize that this is a different time, right? The government has signaled very strongly that they're going to go to great lengths. Do we really think, okay, so let's just talk about mortgage deferrals. Mortgage deferrals are going to go down as one of the most successful programs ever brought about in a recession. It cost the banks nothing, cost the government nothing, and it saved households a lot in terms of just, padding the balance sheet and or the income statement at the most critical time. Do we really think that that was a one and done, and we're not going to see that in the next recession? Like, of course.
I was just gonna say to you, yeah. I was just gonna
say. You can sort of see, well, what was successful, what wasn't successful. That gets added to the playbook, and you'll see it again, right? The risks are plenty. It should be obvious that housing going up, or at this point, single-family houses across the country up 28% year over year, right? That's absurd, and you can't sustain that indefinitely, right? So at some point, the affordability does matter, and we are, even with record low rates, we're pushing record high in terms of carrying costs as a share of income, which is something I track every quarter. BC and Ontario are at record highs. Interestingly, Alberta is still below long-term average, which we'll talk about. Quebec is just only marginally above their kind of norms. But you can't expect that you're going to lap 30% growth this time next year, and we'll be talking about another 10 or 20%. That's pretty unlikely, right? So these markets often will just go through these consolidations phases where you'll see a bit of a pullback, and I think that'd be quite natural at this point. The big risk in my mind at this point in the near term is an inflation scare. So I do think that inflation is going to come back. I'm happy to talk about kind of why that is. I think that, and Steve, you know me, I've been very much in the disinflation camp for years, right? Debt, demographics, technology, all of that I think has been tremendously, globalization, and all these things have been tremendously disinflationary for years. But all of that focuses on private sector credit creation, really, right? And the impact on that one segment, or that one tap, let's say. And that's not the only way that we create money in the economies today, right? And just as important is the fact that the governments absolutely can create money, and they can create it into existence through spending, through deficit spending, and especially when the deficits are going to be financed by the central banks, which is exactly what we're seeing today. And so, make no mistake, governments can always create inflation. I mean, it's ridiculous to think that they can't. And the question is not can they, it's do they have the political will to? And in my opinion, the difference between now and, let's say, 2010 is in the US, you don't have a strong kind of Tea Party movement to really rein in spending. In Canada, you don't have the conservatives that are holding government. You've got the Liberals, which have a very different view on spending, right? We're very much moving towards kind of an MMT framework. And let's be honest, we're going to have an election later this year. It's really hard for me to see anybody unseating Trudeau, right? Regardless of how you feel about him, let's just be honest. The Conservatives look like a mess. I don't see the NDP gaining any traction. At this point, it looks like a cakewalk, right? So the only question in my mind is, if you look at the U.S., what's going to happen in the midterms? Can the Republicans pick up some seats, and can they sort of scare the Democrats into changing their spending plans? But barring that, I mean, inflation. I mean, this idea that the inflation that we're seeing right now is a function of base effects is ludicrous, right? So if you look at core CPI last month, we just saw the single largest seasonally adjusted monthly increase in 40 years. So this is not like everyone's going, oh yeah, inflation's ticking up, but that's just because we're lapping last year when we were about to fall off a cliff. No, that's not what's happening here. You're seeing accelerating inflation in real time. You can see it in the core CPI. You can see it in the GDP deflator from Q1, which just saw the largest quarterly increase in 40 years, right? You can see it in things like, everything, the industrial product price index, 40-year highs, right? If you look at the PMI, the output prices, there's record highs, right? You look at CFIB, the Federation of Independent Businesses, and they're polling their own business owner clients or members, and their pricing intentions are through the roof, right? And so the question is, okay, so you got pricing pressures coming, and are businesses going to absorb that into their margins, or are they going to pass it on to consumers? Well, you and I just talked about the fact that Canadian consumers came out of the recession in better shape than they went in, with a massive amount of cash on the sidelines. And more importantly, I don't know if you're seeing this, but I'm absolutely seeing this. the psychology around inflation. People are just accepting that things are paying, that you got to pay more now for things. That's a very different reality than what we saw even 10 years ago. So I don't buy that. Okay, I buy that we're going to see a transitory jump in inflation. Okay, it's going to jump up for a while. And the central banks are saying, look, this is going to be temporary. It's going to settle back down. They're right on that. I think they're right. But it's going to settle back down to a higher level. And I think that when that happens later this year, and we don't go back down to 1.5 or 1 or 2%, but maybe we settle closer to 3.5. I don't know what it's going to look like, but it's going to be above where we're used to. I just don't see. I could certainly see a scenario where bond yields trade up substantially. I mean, you're still today looking at the 5-year at 90 basis points.
Right. And so what's your view on that though? Because I mean, obviously, okay,
well,
so bond yields tick higher, right? So you've got the Canada. I can tell you, a 5-year mortgage today fixed is 2.1. So what those that 5-year mortgage, for example, I mean, you keep this on housing. Let's say they tick up to 3%, 3.5%. Obviously, I think the housing market breaks at that point.
I mean, they could get there. Let's just put it in perspective here. So just a couple of years ago, the 5-year bond yield was at 2.5%, and that was without the prospect of a sort of a new regime in inflation, right? So 2.5%. If you get 2.5%, you're looking at more like 4% mortgage rates on 5-year fixed. Now,
and I will remind you that in 2018. I remember because I had all these clients freaking out. Mortgage rates got to 3.5%, and everybody thought they were going to 4%, and buying activity stopped.
Right. And now the difference this time, arguably, is that I do think, two things. One is the Bank of Canada is not moving the overnight rate. And so you could see a scenario where you just end up with this growing differential between fixed and variable. And so everyone just piles into variable, right? Because I don't think you're going to see variable at 3.5, 4%, right?
I totally agree.
And the other thing is, it's not clear to me how much the Bank of Canada is going to let bond yields run before they step in to start buying it again, right? They've sort of signaled to the market. You got to remember, Bank of Canada's backed themselves into a corner. They came out explicitly in 2020, and they said to the market, literally they said this. So if you're a business or a consumer thinking about a major purchase like a home, you can rest assured that interest rates are going to stay low for a long time. Their words, okay? So now what do? You backed yourself into a corner, right? So, I think we're going to see a scenario where inflation's going to rise, bond yields are going to want to rise with it when you get this bit of a scare. Bank of Canada's going to be backed into a corner. It would not surprise me to see them step back in, start buying 5 years, or just buying the curve to try to push it down a little. And you're going to see mortgage rates that'll probably be negative in real terms. Right. So even though they're ticking up, I think they're going to be negative in real terms, which
they already are.
Yeah, they are. Yeah, totally they are. And I think that's going to persist. And so, look, it's hard to know how consumers are going to react to, let's say, if mortgage rates get up to 3.5%, which is not a crazy number, right? Does that tip the market? I don't know. We just, at this point, you still need a lot of supply, but it's one of those risks.
And I'm assuming though, I'm assuming if you're getting sustained inflation where bond yields are trading higher and obviously mortgage rates are a proxy of that you probably got some wage growth in there as well.
Yeah, well, that's the other thing, right? So everybody's saying, you're not going to get sustained inflation unless you get sustained wage growth, right? And you're not going to get sustained wage growth with the unemployment rate still 250 bips above pre-COVID levels, right? Okay. I don't buy that. So if you look at CFIB data from their own members, one of the questions they ask their members is what are the limitations on your growth? And they give them a number of options, right? And one of the options is a shortage of skilled labor, and the other option is a shortage of semi-skilled or unskilled labor. And that's one of kind of 10 options. Well, the share of businesses that are reporting a shortage of skilled and unskilled labor is already above long-term norms substantially. And we entered the COVID downturn with it basically at record highs. There was incredible tightness in the labor market, and I think it was about to spill over into wages when COVID hit. I don't think we've structurally damaged this labor market. I could be wrong on that, but I feel like the recovery is going to snap back very strongly. You've already got job vacancies that spiked to 4.5% last month. That's the highest on the survey record. Granted, only going back to like 2012 or whatever it was. It's not a very long survey, but bottom line is, look, it's already hard for them to find labor. And I don't think that that's going to change. And as we reopen the economy and consumers start putting some of this excess cash to work, it's really hard to envision a scenario where that's not just going to tighten dramatically. Right. So I think wage growth is coming, is the bottom line.
And you think, I mean, I don't know. My personal opinion is like, I think you're going to get inflation too, but I don't think you necessarily, you probably should, I don't think you need to be focused on CPI, is my guess. I think you get inflation.
But it doesn't matter. Okay. But listen.
You know what I mean? Like, I mean, what are they saying? Food inflation was up 1% from last year?
Yeah, but who cares, right?
Housing and shelter, 3%.
The important question is not, okay, listen, you got to differentiate how the world is versus how it should be, right? And the reality is that CPI matters a lot if you're a bond investor. Okay, and that's what they focus on. Now, whether that's right or wrong, who cares? That's what they focus on, right? And that's what's going to move the needle on mortgage rates ultimately. 5-year bond yields start to tick up, and those people that are buying those are absolutely looking at CPI, right? So, look, you and I can have a lengthy discussion about whether that's capturing inflation, and I would tend to side with you that it's probably not. But who cares? That's not the way the world works, right? So look, you're probably going to get inflation. You probably will see bond yields tick up. You probably will see the Bank of Canada step in and sort of, do something to kind of push them down a little, maybe if they get a little unruly. But that is a risk. I mean, it's one of the risks that I see in the market. But it's not, it's hard
people
for
always
to get like super bared up on that alone.
Do you feel? I mean, I personally feel like without implicitly calling it yield curve control, I think quantitative easing is a form of yield curve control, which is what they're already doing.
No, I think that's what they're going to do. If the 5-year gets unruly, right, bond yield, they're going to step in. They're going to flatten it down. It's 100% it's going to be yield curve control, right? Now that's assuming it gets unruly, and it may not. But if it does, I don't think the bank's going to stand there and let the 5-year run back up to 2.5 or 3%. I don't see that.
So let's say shit hits the fan, housing market starts to crater. You're a policymaker, or maybe what do you think policymakers do? Whether you're the policymaker, or if you're looking around saying, what would these guys do? Again, we understand that whether you like it or not, housing, I mean, what I think you put in your report there, was it housing as a percentage of GDP growth in the first quarter was what, over 50%?
Yeah.
So they're housing essentially
residential investment.
So you almost have to keep housing propped up.
Well, that's okay. So that's exactly the issue that they're in right now, right? So again, you don't have to love the game, but you have to recognize how it's being played, right? And right now, if you're a policymaker and you're heading into probably an election later this year, and you're looking at an economy that, it's getting better. It's probably going to get a lot better, but it's not great right now. And really the main source of growth has been the housing sector. Are you going to step in and curb that right now? Like, you're out of your mind, right? So that's why I was kind of laughing. I mean, you saw what I was writing. Like, these people that were saying, oh man, this federal budget, I think they might come out with a capital gains tax. I was like, are you crazy? Right before an election, when that's all we've got going for the economy? Like, you're out of your mind. Now, I will say, you give them a majority, and if we still see housing crazy frothy after an election, well, then all bets are off. But you got to recognize, like, they're not going to step on housing right before an election when that's all we've got going for us right now. So housing is totally safe. The fact that it is so much of the economy, and it's an unhealthy amount of the economy as far as I'm concerned, is exactly the reason why it's safe for now, right? No policymaker is going to touch that.
How do you see this playing out down the road? So the way I look at it, I know, like, Australia, they're talking about this. The head of the Aussie central bank, came out, and he was, he's talking about this intergenerational wealth transfer, where essentially they understand that their policies are obviously exacerbating wealth inequality, where basically because house prices are so high, it's not necessarily that the mortgage payment is completely unbearable. It's the ability to save up for the down payment with after-tax money. And so what's happening is, obviously in Australia, and same thing in Canada, is that a lot of this is basically wealthier parents or boomer parents that have built up massive amounts of home equity that are essentially funding the down payments. So these people can basically get in and make their own mortgage payments. I mean, how do you see this playing out like down the road, let's say 5, 10, 15 years from now? I mean, again, we understand that policymakers, housing has gotten so massive. It is the economy that you can't really just come in and let's push house prices down by 30% and make them affordable again. So you're almost...
That's not going to fly, right? You saw, that was the other funny thing, is you saw Adam Vaughan, who is the parliamentary secretary on housing, go on TVO and explicitly say, we're not going to support any measure that's going to drive prices down, okay? And he even came out and said as much as like, it was like, you know, if a 10% housing correction happened, well, how would you stop it at 10%? And we're watching this going like 10%. He suddenly brings you back to like August 2020 levels, right? Like it's nothing, but there's a guy that's plugged into the policies, explicitly telling you ahead of the budget that they're not willing to support anything, and everybody's shocked that the feds don't bring on any meaningful changes. Like, of course they're not going to, right? Okay, so what should they do and what could they do? There's no silver bullet here, all right? What they ought to do, and one of the policy errors, okay, in Canada, it's like politically incorrect to have even an open discussion around immigration policy. And I hate that, right? Like, it's very difficult to even say, should we question our immigration targets? Should we ensure that the federal targets for immigration square with municipal guidelines around housing construction? Because where are you going to house these people, right? And so one of the concerns that I had is when we were watching non-permanent resident growth explode in kind of 2018, 2019. And most of that was international students, primarily international students, but also some work permit holders. And so the feds had these very aggressive targets, right? But they weren't coordinating with municipalities around housing like strategy. Like where are we going to put all these people, right? And so it had the effect of dramatically tightening the rental market. We saw that 2018, 2019. It changed the economics of renting. It forced some people out of the long-term rental market into the ownership market because rents got so crazy. Brought in I suspect, a lot of speculation into the rental market. So you saw, look, there was that was poor planning on the government's part. And I have no issues. Of course, we need very strong immigration. You can see natural increase, which is kind of births minus deaths in Canada, keeps trending down. So this is something that we need for long-term projects. I have no issues with that. But the feds need to sit down with municipalities across the country and figure out how they're going to make this work, right? Because otherwise it's short-sighted policy. But we can't have that discussion in Canada without having people like, I don't know, get all weird
dog pile on top of you.
Yeah, right. And that's not helpful. Okay, so look, feds need to do that. Okay, number one. Past that, there's all sorts of policies that it's like, if it makes sense, just friggin' do it. Okay, so is Canada still seen internationally as a safe haven for illicit capital? Yes. And I'll take a moment to plug Sam Cooper's book, which is like mind-boggling how crazy that is and what's happening in Canada, okay? So the feds need to step in and they need to just like, okay, beneficial ownership registry across the country. We ought to know who owns every residential house in the country. You should be able to find it, okay? If it's a numbered company, who's the beneficial owner of that numbered company? No more setting up a shelf company where, you know, the secretary works at a law firm and is sort of like the front for the person that actually, like, none of that bullshit. We want to know who owns it, okay? And if it's some connected foreign national that's politically exposed, you ought to be asking some questions, okay? There ought to be, as you have in parts of Europe, like some of these unexplained wealth inquiries, all right? If you're living in a $5 million house and you're getting like all of these, you know, tax rebates and benefits for low-income households, something doesn't square. And the government ought to have the power to come in and say, like, explain this to us, right? And so that makes total sense to me. I think there's some limitations that you could put in around foreign ownership of residential properties, where you might say you can buy a new property if you want, but you can't take an existing property out of the supply, out of the stock of housing, right? So for example, I believe Australia has that, where you can buy, right?
New property only.
Yeah, that's right. I mean, you could see stuff like that. That's just like there's a lot of little things like that. The money laundering side of things, they absolutely need to crack down on that. But at the end of the day, they need supply, right? They do. They need single family supply, and they need to figure out with municipalities how they're going to make that work, right? Otherwise, it's just they're temporary fixes here and there, right? So I think it's a lot of smaller policies that can move the needle over time, but certainly no silver bullet. So I don't have much for you beyond that.
Do you have any thoughts on sort of our banks' credit? I mean, I know residential mortgage credit growth is running at 10-year highs right now.
It is. Yeah. It's very high.
Do you think the banks are too lenient here?
Well, okay.
I mean, we've got a lot of debt, so we know that people are borrowing the money.
Look, there's always ways around. So you get the B20 stress test, but then you can start to work with a credit union, or you can get an exception from the banks. Certain banks grant a lot of debt service ratio exceptions, much more so than others. And there's always these little. It's like credit is like water; it just wants to find the path of least resistance, and it does. Okay, in Canada, it absolutely does. But the underwriting in Canada is much more stringent. I mean, you know this. It's much more stringent than it was even 5 years ago. Okay, it's not perfect, but it's much more stringent. And so I think what you're seeing in part with the credit growth is there's a lot of refinancing activity happening. And part of the decline in credit card balances, I think, is people are consolidating debt into mortgage. And that's actually not necessarily a bad thing, right? It actually improves the overall debt service ratios for households, right? So I don't know that there's a huge need to tighten up dramatically on the banks. I think, if anything, I think the mortgage industry has an argument here that limiting first-time buyers that want an insured mortgage to 25 years, it's an arbitrary number. 30-year mortgages have worked perfectly fine in the U.S. for years, right? So should first-time buyers be allowed to extend the amortization out a little bit? Like, you could make that argument. Like, I don't think that's going to disrupt the system. So I don't know.
Do you see a return to longer amortizations? Like, I think it's Sweden where you can get was it 100-year amortization?
Yeah, I don't think we're going that direction.
But you know what I mean? I think they basically, it just becomes like a intergenerational, like they literally just pass on the mortgage to the kid.
Yeah.
And then he's got his house and.
Well, let's put it differently. Like, does an arbitrary cap at 25 years for first-time buyers make perfect sense? Like, well, not really. Like, is there an argument to be made that it should be maybe moved out to 30 years? Like, yeah, there's an argument there. Like, however you feel about that. Again, it's not about figuring out what should happen. It's about figuring out what probably will happen, right? And policymakers, I think, will probably listen to the mortgage lobby on that, right? It is an arbitrary number, right? And I think especially you have to keep in mind, a lot of these rule changes were brought about by Evan Siddall. And regardless of what you think about Evan Siddall, he had the ear of the finance department. He was highly respected in Ottawa. And you have to give the guy credit. He took what was a runaway entity, right? This Crown Corporation, CMHC, that they took their mandate and they went out of control under the previous kind of administration there. And they got into all sorts of programs they never should have been in. And Evan Siddall largely de-risked that book, brought down their exposure significantly, and did so without tipping the market into any sort of a downturn, which I wouldn't have thought was possible. But he actually did a masterful job of that. Now, he's no longer there, right? And I don't know, I mean, the new person, Remy Bauer, I think is her name, and I don't know enough about her to get a sense of kind of how she leans on these policies. But it's hard to imagine she's going to be as sort of, I don't know, as conservative as Evan Siddall was. So I think you're probably, under the new regime at CMHC, you're probably likely to see a bit of a softening in their approach to kind of the mortgage industry and some of those regulations. So it wouldn't shock me. I think 30-year amortizations, if they brought them back, I don't think it's going to be the end of the world. I think you can make an argument.
Well, now they're bringing in the shared down payment, the equity program, right?
Yeah, but that's really not getting any uptake. I mean, do you have any clients?
I have nobody using it because everyone's, I'm not sharing my wealth. I'm soon to be millionaire with this house purchase with the government, right? So
no one's going to take that program when prices are rising 20, 25, 30% a year, right? No one's going to do that. Now, I don't know, maybe if the market cools off a little, they get a bit more uptake, but that market, that program was dead in the water from day one.
Yeah, no, that's for sure. So, I guess I just kind of I don't want to take too much of your time here, so I'm going to kind of wrap things up to summarize things. But I guess what's your, just to summarize, we talked about a lot here, but what's your overall view of sort of the national housing market here in the next sort of, let's call it 6 to 18 months? Like, how do you, what's your take? Are we going to see it, is it a 10% correction? Is it more? Is it higher prices? Is it a cooling off and we're back up to, the annual, say 7-8% per year?
Yeah, I think that's probably the most likely. I think we're going to go through a period where there's a cooling in the market. It's going to move back towards some semblance of balance, but we got a long ways to go. We need a lot of new supply. We need a lot of inventory coming online, or you need sales to fall significantly. And sales could really fall significantly. We don't know how much demand was pulled forward. Right? We'll sort of find out spring next year how much demand was pulled forward, but there could have been a lot of demand. I mean, sales were insanely high really for the last 6 months.
A lot of this hinges on immigration too, which, I mean, you've been highlighting a lot. Like, they're really trying to hit their targets. I know they've been, you've pointed out that, they have been hammering down their eligibility requirements, basically saying anybody with a pulse essentially can come in.
Yeah, it's not quite that bad, but you're right. It is interesting to see. Like, one of the things they're doing, there's a kind of I don't know, like the holy grail of immigration in Canada is the express entry draw for permanent residency. And the way that they establish who's invited is there's this comprehensive ranking system, CRS score. And it captures all sorts of things like, age, work experience, education, all this stuff. And that's not arbitrary. That's based on extensive research around employment and income outcomes across those various variables. Okay, so this is like, draws upon significant empirical research. Okay, and so normally that's a very high number. Normally, you look over the past kind of 5 years, that CRS cutoff score. So what they'll do is they'll say, all right, we're going to take 2,000 people in this draw, and they'll take kind of the top 2,000 out of that list based on the CRS score, and then they'll stop. And whatever the number is that they stop at, they publish that as their cutoff score. And it's normally like, I don't know, 700, 750. And then all of a sudden you started seeing it late 2020, just like starts dropping. And it just like plunges. And so now you're consistently seeing CRF cutoff scores that are in like the 500s, right? Which is quite low compared. And so what it's telling you is they are absolutely flexing they're adjusting their metrics, and they're taking kind of lower, I'd say the word lower quality, but that's just, I mean, the CRS scores are lower for the people that they're bringing in, right? And so now what it tells you is that they're very desperate to hit their immigration targets, right? And they're willing to sort of compromise the quote unquote quality of the people they're bringing in, which I think, again, getting back to that discussion, like, should we be discussing that, right? Like, is that a prudent strategy over the longer term, right? I think that's a fair question to ask. But you can't really ask that in Canada without getting all sorts of, wacky comments.
My last question now to wrap this up, which kind of ties in perfectly with this, because we talk about these immigration targets, and everybody seems to want to funnel into Vancouver and Toronto. And so I just look at like house price appreciation now in, say, Alberta or Saskatchewan. It's pretty benign. I mean, first of all, I know you're fairly bullish on Alberta. I don't know if it's Calgary in particular, but I mean, is there like, I'd love to hear your thoughts on that. And number two is, should there be some sort of policy that says, hey, listen, like, if you're recently immigrated here, like, you gotta go to Winnipeg for 2 years.
Right. That's an interesting. I don't know if you could float that, but that's interesting. Okay, let me first off say, on the immigration front, I know everybody wants to draw a straight line between the Fed's permanent immigration target and overall population growth. And it's not that simple. Okay, so even though the Feds are targeting record immigration, like people coming here, right? You're not going to see record total immigration for, I believe, several years. Right? And we can get into the specifics of that, but there's a lot of moving parts to the overall population growth numbers, and the effect of non-permanent residence matters a lot. There's also outflows. People do leave Canada that we forget about. And with the U.S. now opening their borders, you are going to see more outflows, right? It will stop. But look, My take on that is I think you're going to see population growth a little weaker than people think for the next couple of years. And I think that it's actually going to lead to a slightly weaker rental market than we're used to. Okay, so I want to be clear on that. Rents in places like Toronto are going to be up sharply next year just off of base effects. But I don't think you're going to go back to peak 2019 levels for quite a while. It's going to take a while to grind back up to those levels. And I also think if you look at like purpose-built vacancy rates, which went from kind of 1% to 6% in Toronto, I think it's going to be a few years before you get back down to that 1% range, which has kind of been the norm over the last few years.
Record apartments under construction.
You get a lot of rental apartments under construction, yeah, and interestingly, not really a lot of single family. So we're building a lot of the segment that has been a little soft, and not nearly enough of what has been, red hot, right? So you're right. You've got almost 100,000 rental dwellings under construction across the country, which is by far the highest in the data that we have. And so I think, you're going to have a lot of new supply still coming online. It's going to come at a time where population growth is going to be a little soft, and it's going to be a while getting back up to 2019 levels. Okay, so, and I think that could matter for, if you're someone in Toronto that's got a cash flow negative condo and you were banking on very rapid rent appreciation to get back to 2019 levels, you might be waiting longer than you expected. Okay, that's one thing. Alberta, on a relative basis, it's a no-brainer. So whatever you assume the Canadian average is going to look like whatever you think Canada's going to do over the next few years, I think Alberta's going to outperform for a few reasons. I mean, I don't want to get too far down the rabbit hole of like hydrocarbons and just how close we are to the end of that era, but I think that some of that hype is overdone. And you can see that in the pricing right now. And for the first time in many, many years, we've seen CapEx in Alberta actually tick up last quarter, right? So there's new investment coming back in for the first time. But you don't have to make it too complicated. You've got in Alberta a very young, very educated workforce. You've got world-class cities like Calgary that consistently rank kind of top 10 globally. You've got incredibly cheap office and commercial rents right now, right? And so when you think about a company that's looking for a really great place to locate, start to build out, Calgary looks pretty awesome right now. And it's interesting. Just last week, you saw, I forget the name of the big tech company, but they announced plans to move to set up shop, make their Canadian headquarters in Calgary, and then hire 1,000 kind of tech people in the city. I think that's just the start of a long trend there. So I think that, regardless of what happens at the national level, Calgary is going to outperform, right? So if you think prices nationally overall are going to be up a few percent, like Calgary will probably do better. If they're going to be down 5%, well, maybe Calgary's flat. Like whatever you think it's going to look like, Calgary looks like compelling value at this point, as far as I'm concerned.
I love it. Let's end it there. This has been a splice. For those that want to subscribe or just reach out to you in general, what's the best way to get a hold of you here?
Sure. Yeah. Thanks. So my website is edgeanalytics.ca. You can, if you're sort of in the real estate space, you can reach out to me there. If you're more on the institutional investment side, ben@northcove.net, and happy to talk to anybody or just follow up on any questions there.
And your Twitter handle?
@Ben Rabidoux. Rabidoux, just like it sounds.
It's a good follow, so everybody go check it out. But
thanks, man.
Thanks a lot for taking the time, man. I really appreciate it. Time is valuable here, and really appreciate your insights, and I'm sure everybody else did. So thanks again.
My pleasure. Good to catch up, man.
Cheers, buddy.